Thank you, and a big hello from London. Another small number of weekly patterns this past week. In the currencies, we had a weekly key reversal down in Euro, Swiss franc, but only just. And because of the lukewarm nature of the original pattern, I was not really surprised to see a reactionary move back up this week, though we are still within last week's range. In US dollar, Taiwanese dollar, we saw a weekly key reversal up last week in an unusual position at the top of the market since early May, and 5 weeks after an earlier weekly key reversal up. This week we started lower, but then regained the initiative with further highs yesterday and looking dollar positive today as well. We also had a weekly key reversal down in US dollar Russian ruble 1 month NDF. This has not followed through this week. In the commodities, we saw a weekly key reversal up last week in London sugar futures, one that was not supported by any such pattern in New York sugar futures. This move up in London sugar futures was part of an attempt to break up and out of a September to date based bright red bear channel, which, whilst not a dead move as yet, has so far proved to be, well, potentially a false break, with prices this week pulling back down just in and out of the bright red bear channel, though recently we have moved back up about above it again. I'll cover this more fully in my weekly sugar video commentaries published on Monday of this week. We also had a combined weekly key reversal up and weekly bullish engulfing pattern last week in the sugar white premium. However, this has been a bit of a disappointment this week, as prices have so far opened below the bright red neckline of the February to September head and shoulders pattern, which dominates this market, and have, not resolutely, but they have stayed below it. I cover this more fully in the same weekly sugar video commentaries published on Monday. Meanwhile, in the Baltic Dirty Tanker Index, we had a weekly key reversal up last week. We saw a limited follow-on higher this week on Monday, followed by a larger, though not excessive, pullback lower yesterday. Finally, this last bit is not a weekly pattern, but I thought it worth discussing this market as prices here have had some significant activity in recent days, and I thought I would give a quick take on what is happening in Bitcoin. So if you're looking at a break here below the long moving average, you would need to take a look in the rearview mirror. 2 weeks ago we had a breach and then a proper break lower last week, below the gold long moving average, currently 102.742. This was the first real strategic bearish action, as in not just a pullback in a bullish market, but a proper bearish move lower since at least April. That on its own would not have prompted me to include Bitcoin here, as we saw a breach lower back in April this year that soon turned back upwards. However, the move continued lower, and last Monday we had a first close below the very significant dark blue August 24 to date uptrend, currently at 94.344. This uptrend is the source of the most recent and extended move higher, and I would say it is more important than the gold long moving average on my daily chart. We had a second consecutive close below this uptrend yesterday, which is also significant, though it was a higher close and nearer to the breached uptrend. Thus, I'm not just ready just yet to say that the market has stabilized below the uptrend. But the next few days here will be crucial to the subsequent direction of this market. You may note, if you look at my daily Bitcoin chart, that after the lesser Fibonacci line at 92.734, we really don't have that much support below until the pink neckline extension of the August to October 2024 reverse head and shoulders bottom pattern, which is currently at 84.991, and this would be true. This neckline helped hold up the market back in April with the aid back then of the gold long moving average. However, this time these two are spaced apart, and though near the pink neckline there is a lesser Fibonacci line at 84.607, this is not the same, so I'm not too sure on the strength of this lesser Fibonacci line, but I do note just below we do have the 50% Fibonacci line of the January 24 to October 25 move at 82.379, which is in the midst of some congestion seen back in March and April. This lack of immediate supports below the market prompted me to consider looking at the most recent action, since early October as a possible quite steep bear channel. And I've drawn one in bright green, currently 88,109 to 105,784. I should say at this time that this is only a 3-pointer bear channel right now, not enough to justify it. But in the absence of any other supports or supports out there, it seemed prudent to highlight it. As it is, yesterday's low was awfully close to the lower bear channel line, and I'm now thinking that we could call it a 4-pointer. Still not enough, but it's a step in the right direction for this pattern, if that is the way the market wishes to go. It doesn't stop the market being bearish, but it does seek to quantify and corral the bearishness within a specific pattern. If this does look like working, then I may further finesse it into an October-based bearish shift pitchfork. Now, one final point. I do note the bearish dead cross of the short medium moving average, currently 110,704, down through the medium moving average, currently 111,196. Please note this is a lagging indicator here, just confirming something that we already knew. As always, I'm happy to answer any direct questions with anyone who's interested. And with that, I'll finish this section from London, and I hope that you found these comments useful.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.